You lost money today, and yesterday, and every day before that.
Last episode, I told you that you are the collateral for $36 trillion in debt you never agreed to, that every dollar the government borrows is a claim on your future labor, and that when the interest payments get too high, they don't default, they print. Today we're going to follow that thread to its conclusion, because the money printer doesn't run forever. Every empire that tried it learned the same lesson, and the United States is not exempt from math. Welcome to Exit Velocity. Let's start with a number that should terrify you. In 2025, the United States government spent more than $1.1 trillion just on interest payments, not on roads, not on the military, not on Social Security, just on interest, the cost of having borrowed so much money. That single line item is now the largest expense in the federal budget, larger than defense, larger than Medicare. And here's why that matters. The debt is still growing. The government is still running deficits of $1.5 to $2 trillion per year. Every new dollar of debt adds to the pile that needs servicing. And as interest rates stay elevated, the cost of servicing old debt goes up too. It's a feedback loop. More debt means more interest. More interest means bigger deficits. Bigger deficits mean more debt. Repeat. This is what mathematicians call a compounding problem. And it's the same reason credit card debt destroys people. Except this time, it's the most powerful government on earth holding the card. So what are the options? There are really only 4 ways out of a sovereign debt crisis. You can grow your way out. You can cut your way out. You can default. Or you can inflate your way out. Let's take them one at a time. Option 1, grow your way out. If the economy grows fast enough, tax revenue rises, and the debt becomes a smaller percentage of GDP. This is how the U.S. handled its World War II debt. Between 1945 and 1970, strong economic growth and moderate inflation shrank the debt to GDP ratio from 120% down to about 35%. But that required decades of real productivity gains, a manufacturing boom, cheap energy, and a baby boom that expanded the workforce. None of those conditions exist today. GDP growth is averaging 2 to 3%. The debt is growing at 7 to 8%. You cannot outgrow a debt that expands 3 times faster than your economy. Option 2, cut spending. In theory, the government could balance the budget by slashing programs. In practice, this is politically impossible. The 3 biggest spending categories, Social Security, Medicare, and interest on the debt, account for roughly 70% of the federal budget. Social Security and Medicare are politically untouchable. Interest payments are legally required. That leaves 30% of the budget, defense, education, infrastructure, everything else, to cut. And even eliminating every single discretionary dollar wouldn't close the deficit. The math is that bad. Option 3, default. The government could simply refuse to pay its debts. This has happened in other countries. Russia in 1998, Argentina in 2001, Greece effectively in 2012. But the United States has never defaulted on its treasury bonds, and doing so would cause a global financial earthquake. Trillions of dollars in pensions, insurance reserves, and foreign central bank holdings are denominated in U.S. treasuries. A default would destroy the dollar's status as the world's reserve currency overnight. No American politician will choose this option voluntarily. It would be economic suicide. Which leaves option 4, inflate your way out. And this is the one they always choose, because it's the only one that doesn't require voters to sacrifice anything today. It pushes the cost into the future and disguises it as rising prices. Here's how it works. The Federal Reserve creates new money and uses it to buy treasury bonds. This keeps interest rates artificially low, which makes the debt cheaper to service in the short term. But those new dollars enter the economy and dilute the purchasing power of every dollar already in circulation. Prices rise, your savings lose value, your paycheck buys less. The trick, and this is the cruel genius of it, is that inflation also shrinks the real value of the debt. If you owe $36 trillion and you double the money supply, your debt is still $36 trillion on paper, but each of those dollars is worth half what it used to be. In real terms, you've cut the debt in half without paying a cent. The catch is that you've also cut the purchasing power of every working person's savings in half. The government wins. You lose. This isn't speculation. This is exactly what happened between 2020 and 2023. The Federal Reserve created roughly $5 trillion. Inflation surged to 9%. Your groceries, your rent, your gas, everything got more expensive, and the government's debt, in real terms, got cheaper. That wasn't a side effect. That was the mechanism working as designed. Now let's look at where this road leads, because history has mapped it out clearly. Rome. The denarius was the backbone of Roman commerce for centuries. But as the empire expanded and military spending spiraled, emperors began reducing the silver content of coins. Under Nero, the denarius was 94% silver. By the time of Gallienus, 200 years later, it was less than 5%. Prices exploded. Trade collapsed. The empire fractured. Rome didn't fall to barbarians. It fell to bad money. Weimar Germany. After World War I, Germany owed massive reparations. Rather than tax its citizens or cut spending, the Weimar government printed marks. By November 1923, it took 4.2 trillion marks to buy a single US dollar. Workers were paid twice a day so they could spend their wages before they lost value. People burned currency for heat because it was cheaper than buying firewood. An entire middle class was wiped out in months. Zimbabwe. In the 2000s, the Mugabe government printed money to fund spending. By November 2008, inflation hit 79.6 billion % per month. Prices doubled every 24 hours. The Zimbabwe dollar became so worthless that $100 trillion notes couldn't buy a loaf of bread. Argentina, Venezuela, Lebanon, Turkey. The pattern is always the same. Government spends more than it earns, borrows to cover the gap, prints money to service the borrowing, currency collapses, savings evaporate, the middle class gets destroyed. Now. I am not saying the United States is about to become Zimbabwe. The dollar has one massive structural advantage. It's the world's reserve currency. Global demand for dollars creates a buffer that smaller currencies don't have. That buffer has allowed the U.S. to run deficits and print money at a scale that would have collapsed any other currency decades ago. But buffers erode. In 2000, the dollar made up about 71% of global foreign exchange reserves. Today, it's around 58%. Countries are diversifying. China, Russia, Brazil, Saudi Arabia, they're settling more trade in yuan, rubles, and gold. The BRICS nations are actively building alternatives to the dollar-based financial system. The endgame isn't a single dramatic collapse, it's a slow grind. The money printer runs a little more each year. Prices rise a little faster. Your purchasing power fades a little more. Each generation inherits a weaker dollar than the one before. So what does this mean for you? It means that storing the value of your labor in dollars is a guaranteed loss. Not a risk, a guarantee. The Federal Reserve's stated goal is 2% inflation per year. Even at that target, your dollars lose half their purchasing power every 36 years. But inflation has been running closer to 5%. At that rate, your dollars lose half their value in just 14 years. Bitcoin was built for this moment because it's the only money in human history with a supply that cannot be expanded. 21 million coins. Ever. No Federal Reserve chairman can create more. No emergency session of Congress can authorize more. No quantitative easing program can dilute your share. When the money printer's endgame plays out, whether it takes 5 years or 50, every person who stored their wealth in dollars will watch it evaporate. And every person who converted even a portion of their savings into Bitcoin will be holding an asset that no government, no central bank, and no politician can debase. The money printer has an endgame. It always has. The only question is whether you'll still be holding dollars when it arrives. Next episode, we're going to look at the other side of this equation. Everyone talks about what's wrong with the dollar. But what actually makes Bitcoin different? Why 21 million? Why can't anyone change it? And why should you trust math over institutions? That's episode 10. Why 21 million? Until then, think in Bitcoin.